What if I told you that every major crisis in human history has created the same predictable pattern, a massive shift toward one specific asset that has preserved wealth for over 5,000 years? And what if understanding this pattern could be the key to protecting and growing your wealth in uncertain times? Today, we're diving deep into the fascinating relationship between historic chaos and gold investment choices. From ancient civilizations to modern financial crises, we'll uncover why gold becomes the ultimate safe haven when the world turns upside down. If you want to understand how history's biggest events can guide your investment strategy, hit that like button and subscribe for more wealth-building insights. For over 5 millennia, gold has held a unique position in human civilization. But here's what most people don't understand. Gold's true power isn't just in its scarcity or beauty. It's in how predictably human psychology turns to this precious metal during times of uncertainty. Every major historical disruption follows the same pattern. When traditional systems fail, when currencies collapse, when wars rage, or when economic uncertainty spreads like wildfire, investors don't just randomly choose assets, they instinctively turn to gold. Think about it. Your great-grandparents, their great-grandparents, and dozens of generations before them all witnessed the same phenomenon. When chaos strikes, gold becomes the universal language of security. Let's start with one of the most defining moments in modern financial history, the Great Depression of the 1930s. When the stock market crashed in 1929, millions of Americans watched their paper wealth evaporate overnight. But those who understood history's lessons had already begun shifting their portfolios. In 1933, President Franklin D. Roosevelt made one of the most dramatic financial decisions in American history. He banned private gold ownership through Executive Order 6102. Why? Because so many Americans were converting their dollars into gold that it threatened the entire monetary system. The government was literally competing with its own citizens for gold reserves. Here's the shocking part. Those who held gold before the ban saw their wealth protected. When the government finally revalued gold from $20.67 to $35 per ounce in 1934, it represented a 69% increase overnight. While millions struggled with unemployment and poverty, gold holders experienced significant wealth preservation and growth. This wasn't luck, it was pattern recognition. Smart investors understood that when paper currencies come under pressure, gold becomes the refuge of choice. World War II created perhaps the most dramatic wealth shift in modern history. As Nazi Germany expanded across Europe, wealthy families and institutions faced an impossible choice: stay and risk losing everything, or find a way to preserve their wealth across borders and through chaos. Gold became the ultimate portable wealth. Unlike real estate, stocks, or businesses that could be seized, bombed, or nationalized, gold could be hidden, transported, and converted to local currency anywhere in the world. Jewish families fleeing persecution, resistance fighters funding operations, and even governments in exile all relied on gold's universal acceptance. The Swiss banks understood this dynamic perfectly. They became the destination for gold-fleeing, war-torn Europe, establishing Switzerland's reputation as a safe haven that continues today. This wasn't just about hoarding precious metal. It was about understanding that, in times of extreme uncertainty, gold becomes the closest thing to universal currency. But here's the deeper lesson. Those who recognized the pattern early and shifted to gold before the crisis hit saw the greatest preservation of wealth. Those who waited until panic set in often found themselves unable to make the transition effectively. Fast forward to August 15, 1971, a date that forever changed the global financial system. President Richard Nixon announced that the United States would no longer convert dollars to gold at a fixed rate. This decision, known as the Nixon Shock, effectively ended the Bretton Woods system and ushered in the era of fiat currency. What happened next perfectly illustrates how historic events shape investment choices. In the decade following Nixon's announcement, gold prices exploded from $35 per ounce to over $850 per ounce by 1980, a staggering 2,400% increase. Why such a dramatic shift? Because removing the gold standard created a fundamental uncertainty about currency values. Investors worldwide recognized that without gold backing, paper currencies were subject to inflation, political manipulation, and economic volatility in ways they had never been before. Smart investors didn't wait for confirmation, they understood the historical pattern. When monetary systems undergo fundamental changes, gold becomes the anchor of stability. Those who recognize this pattern early position themselves for one of the greatest wealth transfers in modern history. The 2008 financial crisis provides perhaps the clearest modern example of how historic events drive gold investment choices. When Lehman Brothers collapsed and the entire global financial system teetered on the edge of collapse, we witnessed the same pattern that had played out for centuries. As real estate values plummeted, stock markets crashed, and major financial institutions failed, gold prices surged from around $800 per ounce in 2008 to over $1,900 per ounce by 2011. But here's what makes this particularly interesting. The investors who profited most weren't just lucky. They were applying historical pattern recognition. Warren Buffett, despite his famous skepticism of gold, acknowledged during this period that gold gets dug out of the ground in Africa, gets melted down, and then gets buried again in Fort Knox. It has no utility. Yet even Buffett couldn't ignore that during times of systemic financial stress, gold becomes the preferred store of value. The COVID-19 pandemic provided a real-time case study in how contemporary historic events continue to shape gold investment choices. As governments worldwide printed trillions of dollars in stimulus money and implemented unprecedented monetary policies, savvy investors recognized familiar patterns from history. Gold prices surged to new all-time highs above $2,000 per ounce as investors applied lessons learned from previous crises. The pattern was unmistakable. Unprecedented government intervention in economies, massive currency creation, and global uncertainty. The same conditions that have driven gold investment for millennia. But this time, we also saw the emergence of new forms of digital gold like Bitcoin, creating an interesting dynamic where traditional safe haven assets competed with modern alternatives. Yet gold maintained its position as the preferred crisis hedge for institutional investors, central banks, and experienced wealth managers. Perhaps the most telling indicator of gold's role during historic events comes from central bank behavior. These institutions, with access to the world's best economic data and analysis, consistently increase their gold reserves during times of uncertainty. In 2022 and 2023, central banks purchased gold at the fastest pace in over 50 years. Russia, China, India, and dozens of other nations dramatically increased their gold reserves. Why? Because central bankers understand the historical pattern better than anyone. When global financial systems face stress, gold provides stability and credibility that paper currencies cannot match. This isn't speculation or emotion. It's institutional recognition of a pattern that has held true throughout human history. When the world's central banks consistently choose gold during uncertain times, they're applying the same historical analysis that smart individual investors use. Understanding why historic events drive gold investment choices requires examining the deeper psychological forces at play. During times of crisis, several psychological factors converge to make gold irresistibly attractive. Fear of currency debasement. Throughout history, governments under pressure have consistently debased their currencies. From Roman emperors mixing lead with silver coins to modern quantitative easing programs, the pattern remains constant. Gold provides protection against this historical inevitability. Need for tangible security. During crises, abstract financial instruments lose their appeal. Gold's physical nature provides psychological comfort that paper assets cannot match. You can hold it, store it, and know it exists independently of any institution or system. Collective memory. Even investors who haven't personally experienced major crises carry the collective memory of previous generations. Stories of hyperinflation, currency collapses, and financial system failures create a deep-seated understanding that gold serves as the ultimate insurance policy. Universal acceptance. Unlike stocks, bonds, or even real estate, gold has universal recognition and acceptance. This global liquidity becomes crucial during times when traditional markets may be closed or dysfunctional. The most successful gold investors don't wait for crises to hit. They recognize the early warning signs and position themselves before the crowd awakens to the pattern. Historical analysis reveals several key indicators that typically precede major shifts to gold. Monetary policy extremes. When central banks implement unprecedented policies, whether extremely low interest rates, quantitative easing, or direct market intervention, history suggests gold investment increases typically follow. Geopolitical tensions. Rising conflicts, trade wars, or diplomatic breakdowns have consistently preceded gold price increases throughout history. Smart investors monitor geopolitical developments not just for their immediate impact, but for their historical precedents. Currency instability. When major currencies show signs of weakness or when currency wars begin, the historical pattern suggests increased gold demand follows. This includes inflation concerns, debt ceiling crises, or international dollar alternatives. System stress indicators. High-profile financial institution failures, market volatility spikes, or unusual government interventions in markets have historically preceded significant gold investment flows. Understanding how historic events shape gold investment choices isn't just academic, it has practical applications for modern portfolio construction. The key insight is that gold functions differently during different types of historic events. During inflation, crises, gold has historically provided excellent protection against currency purchasing power loss. The 1970s inflation period saw gold prices increase dramatically as investors sought to preserve their wealth's real value. During deflation fears. Paradoxically, gold also performs well during deflationary periods when investors fear economic collapse. The Great Depression example shows how gold provides stability when other assets lose value rapidly. During currency crises, when specific currencies come under pressure, gold provides an escape valve for wealth preservation. This has been particularly evident in emerging market crises throughout recent decades. During system-wide financial stress, when entire financial systems face uncertainty, gold's independence from any particular institution or government becomes its greatest strength. The optimal allocation to gold, based on historical patterns, typically ranges from 5 to 20% of a portfolio, depending on the investor's risk tolerance and the current economic environment. However, during periods that match historical crisis patterns, successful investors have often increased their gold allocation significantly. While gold's fundamental role during historic events remains constant, the digital age has created new ways to access and trade gold investments. Exchange-traded funds, digital gold platforms, and even gold-backed cryptocurrencies now provide modern methods to participate in this ancient pattern. However, the core principle remains unchanged. During times of uncertainty, investors seek the stability and universal acceptance that gold has provided throughout history. Whether held physically through ETFs or via digital platforms, the underlying pattern of crisis-driven gold demand continues. Modern technology has also made it easier to recognize and respond to historical patterns. Real-time data, advanced analytics, and global information flow allow today's investors to identify crisis patterns more quickly than ever before. The pattern of historic events driving gold investment isn't limited to Western economies. Examples from around the world reinforce the universal nature of this phenomenon. Asian financial crisis of 1997. As currencies collapsed across Asia, gold demand surged as investors sought stability outside their domestic financial systems. European debt crisis from 2010 to 2012. Greek investors dramatically increased gold holdings as they lost confidence in their domestic financial institutions and the euro itself. Italian investors dramatically increased gold holdings as they lost confidence in their domestic financial institutions and the euro itself. Spanish investors dramatically increased gold holdings as they lost confidence in their domestic financial institutions and the euro itself. Turkish Lira crisis of 2018. Turkish citizens rushed to gold as their currency lost value rapidly, demonstrating how currency crises drive precious metal demand. Argentine economic crisis of 2001. Argentinians who held gold maintained their wealth while those who trusted the peso saw their savings evaporate. These international examples reinforce that the relationship between historic events and gold investment choices transcends cultural, geographical, and political boundaries. It's a universal human response to uncertainty. The evidence is overwhelming. Throughout human history, major disruptive events have consistently driven investors toward gold. This isn't superstition or outdated thinking. It's pattern recognition based on thousands of years of human behavior under stress. From the Great Depression to World War II, from the Nixon Shock to the 2008 financial crisis, from COVID-19 to current geopolitical tensions, the pattern remains remarkably consistent. When traditional systems face stress, when currencies come under pressure, when uncertainty dominates headlines, investors instinctively turn to the asset that has preserved wealth longer than any other. The key insight isn't just that gold performs well during crises, it's that understanding this historical pattern allows intelligent investors to position themselves before the crowd recognizes what's happening. Those who study history don't just learn from the past, they gain the ability to anticipate future market behavior. As we face an uncertain global economic environment with unprecedented debt levels, complex geopolitical tensions, and evolving monetary systems, the historical pattern suggests that understanding gold's role in portfolio protection becomes more important than ever. The shift to gold isn't just about precious metals. It's about recognizing how human nature responds to uncertainty and using that knowledge to make smarter investment decisions. History doesn't repeat exactly, but it certainly rhymes, and the rhythm it follows has consistently pointed toward gold during times of stress. If this analysis of history's patterns and their investment implications opened your eyes to new possibilities, show your support by hitting that like button. And don't forget to subscribe for more deep dives into how historical understanding can transform your investment strategy. Your future self will thank you for learning these timeless lessons today. Remember, those who understand history's patterns don't just preserve their wealth, they position themselves to thrive when others struggle. The shift to gold isn't just an investment strategy, it's a lesson in how to read the signs that history provides and act on them before the crowd catches